Welcome, everyone. Thank you for joining us for today's webinar. My name is Chris, and I am your host as well as the marketing manager over here at EBS Associates. Today, we are presenting lesson 4 of 6 of our cash flow webinar series presented by Mike Milan. As always, just a bit of housekeeping before we get started in case we have any new listeners. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. I will do my best to answer the questions, and if I cannot, I will ask Mike, and there will also be Q&A at the end as well. If you do not have the slide deck and you'd like to follow along with Mike, please let me know, and I will email that over to you during the presentation. Just ask me in the question box, and I'll be happy to send that over to you. So without further ado, here is Mike Milan.
Hey guys, all right, welcome back. This is number 4 of 6, so we are cranking along. And I have got to tell you, this one's going to be a grinder, right? I mean, you can already tell from the first slide I got up, we're going to grind through it. So if you've been waiting for numbers, if you've been waiting to get your calculators out, if you've been waiting to do some analysis, today's the day, right? Everything we've done the last 3 weeks is leading up to right now. So welcome back. Thanks for joining me. If I look a little tired, I'm in Vegas, right? I'm at a conference in Vegas, but I'm still here with you right now, 1 o'clock Pacific time. But here we go. All right, just as a refresher, all right, we kind of talked about building transferable value in lesson 1. In lesson 2, we talked about different personalities and different ways to work with other people, right? It was kind of a softer issues that way. In lesson 3, we got right down to how to methodically go through a set of financial statements and look for at least what I call initial financial indicators. You know, those are the things that we look at right up front to be able to get a grasp over the health of the organization, right? So we looked at, the 5 IFIs that I look at are trends. We got expense control. We got debt to equity, EBITDA, and misfinancing. And what we found out in our company, the company that we're talking about is Spectrum Manufacturing. And in Spectrum Manufacturing, it's a 60-year-old company. The current owner, Sammy, has been the president for 30 years. His son's in line, all right, to take over the company. And they're asking for a $3 million line of credit. I'm sorry, a $300,000 line of credit because they're expecting a $3 million contract. So $300,000 on $3 million, he thinks, about 10% ought to get it. We don't know if that's enough. We don't know if he can take on the line, but here's what we found out in the last section of the 5 IFIs. He has bad trends. His sales, his operating costs, his gross profit, his net profit, everything's down. His expense control was off by about 100,000, right? And expense control was the change in operating expense should mirror the change in gross profit. And we're off about 100,000 there that he needs to cut. From a debt to equity, he's good, right? We said debt to equity, the guiding post is 2.5 or less. He's at a 1.45. So he's got room for more debt if he needs it. His EBITDA was really pretty strong. It was 323,000. And if we take that times 3, that means he can take on about $1 million in long-term debt. He has about 600,000 of it out right now. So he's got room for 400,000. And then we knew that he was misfinanced, which means he had used his line of credit. If we looked at notes payable, it had increased to pay for some of his expansion. So the fix there, what our initial fix is, hey, listen, maybe he doesn't need 300,000. We don't know how much he really needs, but maybe he doesn't need the 300,000. Maybe we just need to fix his misfinancing, which means take 300,000 off of the line and secure it with the equipment. And that actually frees up the amount of money that he asked for without taking on new debt. So that's one way that we can address, Sammy and his company. But because he does have a loan request out there, we're going to analyze it and see exactly where his problems are. That's what's going to happen over the next 14 equations that we're going to go through in the next hour. 14 different line items that we look at, just like a banker, just like an investor does, to be able to make sure that we know exactly where the problems are in this company, right? Sometimes we don't know where the problems are. We know it just isn't working. Today, we're going to find out where the problems are. So if we're ready to get started, I'm going to say, get out your calculators. We're going to do some work here, right? We're going to do some work on the ratio. So the first 2, current and quick ratio. These are ratios used by bankers primarily because they talk about solvency. And if you know anything about me and the way I teach, I don't like to use words like solvency and liquidity and those type of things because most business owners don't understand it. They don't understand what being solvent really means. So what I like to tell people is, does your business make enough money just to pay for itself? That's all we're talking about right here. Does the business generate enough cash to just pay for itself, right? It's day-to-day operations. And that's why we're looking at the current assets and current liabilities and the current and quick ratio. So in the current ratio, there's a timeline. The biggest difference between these two is the time it takes to convert an asset to cash. So in a current ratio, we're looking at 12 months of the stuff that's on my balance sheet. Can I convert it to cash in 12 months? Of the quick ratio, the timeline is 90 days. So can I convert this to cash in 90 days? And that's what we're looking at mostly. And one of the reasons why the difference between the two is we drop off some of the current assets that we can't convert in 90 days, like inventory. People say, oh, I can get rid of my inventory in 90 days. You can, but probably not without discounting it. And that's what we're talking about. If there's a significant amount of discounting you have to do, you probably can't convert it in 90 days. I'll take it a step further. If you could convert it in 90 days, you wouldn't have a cash flow problem, right? We'd be selling inventory that fast. So that's the difference between the two. 12 months and 90 days is what we're looking at. So when I go back and if on your handouts, on your slides, I'm going to be looking at a couple different pages. We'll be looking at the balance sheet. And for most of these, I'm going to be looking at year 5. We're looking at the income statement, again, year 5. And one extra thing I'm adding in there, right? This is an RMA industry average page. If you're familiar with Finagraph and our old dashboard, industry averages with RMA, Risk Management and Associates, are built in. So we have data that you can compare, but really what we're doing is comparing the NAICS code, NAICS, which is North American Industry Classification System. And it's usually, if you don't know where to find it, in our products, we have a search tool. You just kind of type in keywords and we help you determine what the NAICS code is. Or you can just go look at your tax return and see what you've been, comparing yourself to all along, right? Because you actually self-report your NAICS code on your tax return. Some people don't know that, right? That actually the number here, this one is a 6-digit number. Actually, you self-report on your tax return. You tell the government what industry you're in. So if you don't know that, it might be time to take a look at it because that's who you're being compared with over time. So if you look at the RMA pages, when we start to look at things like this, the first thing I look at is what are they comparing? And we're comparing asset size. So if I go back to the balance sheet, on the balance sheet, my asset size, total assets, is 3.5 million. 3.5 million is kind of what they're comparing. So when I go back to the industry average page, that's the first thing I'm looking at. Sometimes you'll see this as revenue size. So I always look and see what they're comparing. In this case, it's asset size. So we got 500,000 to 2 million, 2 million to 10 million, and 10 million to 50 million. We're going to use the middle column. So I don't even have to look at half of these numbers that are on this page. I can just erase them. I'm only going to look at the middle column to do our industry averages or industry comparisons. And to make it easy, if you download this slideshow and you print it out, these shaded boxes correspond with the actual ratios that I'm calculating. So in this case, number 1, number 2, we already know is quick and current ratio. Here they are. And if you notice on these two ratios, there's 3 numbers in each box. Those are percentiles, right? Which means the upper, 25%, the upper 25%, it has a 2.8 or above. The lower 25% has a 1.4 or below. The average, the middle 50%, is about 1.9. So that's how you read it. If you see 3 numbers, that's what they're referring to. So we're going to be using numbers like 1.9 and 1.1 for the next 2 calculations. I'm just trying to walk you through this so when I show you numbers on the calculation sheet, you know where I'm getting them from, and you know what it is that I'm comparing it to. So getting back to our calculations, we're going to start off with current assets and current liabilities. Again, where I'm getting these from is the actual balance sheet. We got current assets of 2049 and current liabilities, of course, of 1519. Year 5 And I'm going to show you these. I won't do this on every calculation, but I'm doing it now so you can kind of see where I'm getting the numbers from. So when I go back to the ratio page, the first one I got is 2049. The second one is 1519, and that's where they came from. When you divide those, it's going to give you a ratio. And let me tell you something about ratios. In this case, it's 1.35 if you're following along. Ratios don't mean anything, right? Unless you compare them to something else. It's just a number. You can sit there and go, hey, I got a 1.35. You don't know what that means, right? You don't know if it's good. You don't know if it's bad. And that's one of the things I look at. I put a little GFT up here, which is good, fair, or terrible. It helps me get an indication of what type of company this is. Is it a good company, fair company, or a terrible company? And that's just the way I look at it. In this case, you've got a 1.35 on a current ratio. Some people will tell you turnover rates, whatever. When I'm talking to business owners, I try to give them good examples to explain what current ratio means. For instance, I give them an example of a current asset, we'll say checking account. I'll give them an example of a current liability, we'll say credit card. So I'll say, hey, listen, here's what a current ratio means. For every dollar you owe on the credit card, you have $1.35 in the checking account to pay for it, right? That's really what we're talking about. So for every dollar you owe, you've got $1.35 to pay for it. And that's what that means. So is that good, fair, or terrible? Well, we don't know, right? We don't know because we have to compare a ratio to something else. So when we put down the 1.9 from the industry average page I just showed you, Sammy's company has $1.35 to pay for every dollar they own a credit card, but everybody else has $1.90. Now is a good, fair, or terrible, right? In my assumption, my opinion, it's at least fair, right? And it's fair because he can at least pay for himself, right? He's at least being able to pay for his daily operations, because if he wasn't, it would be less than one. So for every dollar he owes, he's got $1.35. If he was less than one, then we got a problem. For instance, when I look at cash and receivables, we're leaving out things like prepaid expenses and inventory, right? Just like I said, we leave out inventory because you probably have to discount it to get rid of it fast. We leave out things like prepaid expenses because, let's face it, once you've already paid for something, you're not getting that money back, chances are. So cash and receivables is what this company has, so I'm going to add those up, and it comes up to 739, right? If you go back and look at the balance sheet, that's what it is. And current liabilities is still the same at 1519. So 739 to 1519. This is, by the way, the most conservative and stringent ratio there is. By far, it's the hardest bar, and it moves all the time. Every day as cash comes in or out, it moves. So if I take 739 divided by the 1519, it's a 0.49, right? 0.49. So for every dollar he owes on the credit card, when we look at it through a really conservative lens, he's only got 49 cents to pay for it. Bing, bing, bing. We've got red flags and some warning signs going off. If I'm the banker, here's what I'm thinking, right? There's 51 cents of risk. That means if this company folds, if this company goes under, somebody's got to eat 51 cents, right? There's only 49 cents to pay for it. And the way the bank looks at it is you use your long-term assets, your equipment, to pay off your long-term debt, and then you use your current assets to pay off your current liabilities. That's the way the bank looks at it. So in this case, they're saying, hey, if we give him a line of credit, which is also short-term current liability, there's 51 cents already exposed, right? So the chances are we're going to have to eat 51 cents in this. So that's the risk. Conversely, everyone else has $1.10. So where he has 49 cents to pay for every dollar on the credit card, everyone else has $1.10 to pay for it. So I'm going to say that's terrible, right? That's terrible. So you're starting to see as we go down through there, I'm getting a feel for how this company is, fair, terrible, or otherwise. Okay, debt to equity, moving down through these. If you went ahead and did them on your own, that's great. Maybe you're just checking your work, and I'm kind of talking through it. But debt to equity, if you remember, was one of our initial financial indicators, right? It was number 3, debt to equity, which is how much does the owner really care about his company? Does he believe in the company? Does he believe in the company good enough to put his own money in, right? This is saying for every dollar that the owner puts in equity, how much did he let the bank put in? Liabilities, right? So every dollar the owner puts in, the banker puts in. Remember, this was a 2.5 or less. We want this one also, I'm sorry, We want that to be 1 or over. 2.5 or less is on the debt to equity. I put it in the wrong spot. And this, we always want that to be 1 or more. So 2.5 or less for debt to equity. And when we add up his, we did this on the IFI's last session. You got 2118 over 1465 gave us a 1.45. So for every dollar that Sammy's put in, he's let the bank put in $1.45, which we're saying is actually good compared to the 2.5 that a bank likes to look at. But is it good when we look at the competitors, right? And our competitors are at 1.3. So when Sammy put $1 in, he let the bank put in $1.45, but every other paint manufacturer out there has only let the bank put in $1.30, on the average. So I'm going to give him a fair score here as well, right? It's still good compared to the bank, but it's fair compared to everyone else. That's the way we're going to look at that. So, and remember, if you're not willing to put money into the bank, or I'm sorry, into your own company, why should the bank? That's why they're looking at it. Okay, number 4, gross profit margin. Gross profit margin. This is really interesting here, going gross profit. And on gross profit, we've got the most important number on the financial statement, right? This is the only money you get to spend, right, is the gross profit margin. So when we look at it from a gross profit perspective, is he good or bad, right? Is he able to generate money? This is also an indication of whether or not where his prices are. He may be, if all inventory costs the same and he's lower than his competitors, maybe his prices are lower, or vice versa. If he's higher, maybe he's pricing it higher. Gives you an indication where you are in the market. In this case, he's got gross profit of 2 million, 2.1, and on sales of 7 million, that gives him a gross profit margin of 30.7 or almost 31%. Everyone else got 32.2%. So 1% difference. Does that matter? Sometimes it does matter, right? Sometimes it does matter. In this case, it does matter because it's about $100,000, and I'll show you how to get to the financial impact of it next. But it will matter, right? It will matter. If you remember our, gross profit margin, when I talked about, 4 ways to make more money, one way was to buy better. We talked about, or I've talked about in the past, Burger King. Burger King was the home of the Whopper, right? And the home of the Whopper, they were the first people to build the value menu. And from the value menu, they created the dollar Whopper Jr. They ran into a gross profit problem in the first quarter of introducing the value menu because people will come in and say, hey, I can get a Whopper for $3.69, or I can get a Whopper Jr. for $1. I'll take 2 Whopper Juniors, right? So they can make a $2 sale instead of a $3.69 sale, which brought dollars down, right? They saw a decrease in dollars just because of the way people were buying. The way they fixed it was they actually, some people say, oh, well, they, went cheap on the ingredients, or they, changed the price and increased the prices. No, the first thing they did was introduce a third option, the double Whopper. And they don't care if anybody in America buys the double Whopper. Matter of fact, I'm probably the only one that's ever bought a double Whopper, the way I look at it. And from that, people would walk in and go, double Whopper, Whopper Jr., like we all buy, I'll take the Whopper, right? We take what's in the middle. They increase sales of the Whopper by introducing a third larger option, which is really pretty smart. So, okay, net profit margin. This is the result, right? This is your report card, right? This is what we all lean on. How much money did I make? Because we are in business to generate money, not to just do it. So in this case, he made $11,000, right? Oh my gosh, $11,000 in a year on $7 million in sales. With that being the case, he made less than 1%, but less than 1/4%. He made 15 basis points is all he made, right? Think about that. This is a good example of practicing working. Because you're not doing it for money. You just go in and do it just for practice, right? I mean, we're just doing it for fun. We're not losing money, but we're, gosh darn it, not making any money. So that does not look good to me. Now, everybody else in the industry is making at least 3%. So if they're making 3% and I'm making less than 1/4%, what did I do all year, right? So to me, you've got fair here because we're right around the average, and you got terrible here because we're not making any money at all, right? So that's our first indicator that he's got a problem. Now, if I'm looking to buy a company like this, I'm looking at that saying, what's he doing wrong? Where's the problem at? Because if he's only making that, it's going to drive the value of the company down. I can get it for a value price and then move it up to get my 3% if I'm just average. That's the way I'm looking at it. Okay, return on assets is one that confuses a whole lot of people, right? Return on assets. Here's why it confuses people. They don't have any idea what it means, right? But there's only one reason to buy an asset, right? There's only one reason to buy anything in a company, and that's to generate revenue or generate profit. That's it. If you're not using it to do that, you don't need it in the company. It's only there to do it. And people say, well, what about this training room, right? We got all these desks and we got all these tables, that's not generating revenue. It is because we use it to put knowledge in the people's heads to create more productivity from our workforce, right? Training is actually an enhancement to revenue, is what we're trying to do. So return on assets, the way you read this is for every dollar you invest in a piece of equipment, how much of that dollar comes back to you in the form of profit? That's what we're looking at. So for every dollar we invest in a piece of equipment, how much of that dollar comes back to you in the form of equipment, right? That's what we're doing. So in the form of profit. So in this case, he makes still $11,000 in profit. We know he has about 3.5 million, 3.6 million in assets. What is his return, right? He's put 3.5 million out, 3.6 million out. He's only got 11,000 back. He's making about 1/3%, a third, right? 1/3 of a penny. So he puts $1 in and 1/3 of a penny comes back, where everyone else gets 8 cents back on every dollar. So I'm going to say he's terrible there too, right? It's not good. It's not good because he's not using the equipment. Now, this from an outsider's perspective, I can look at this and say, there's an opportunity. And the opportunity is he's got underutilized assets, right? He's not using his assets that are on his floor right now to its fullest capacity. He should be at least getting 88 cents off of every dollar. If he's not, that tells me that I can go in and actually take over and increase productivity without buying more equipment. Anytime you buy a company, there's two purchases, right? You got the purchase price, which you give the owner for taking over the company, but there's always another capital investment over the top. And the capital investment over the top is what you bring in with your new stuff, or you have to fix old stuff. You have to get things up and running, because once the guy thinks he's selling, he's not fixing things anymore. He's not keeping it up the way he used to. All right. And remember, our first thing was a successful business owner actually runs his business as if he intends to sell it, even if he doesn't. So we would be the ones that keep our company up and keep our business running well, because we want the money on the purchase price. In this case, I'm looking at it thinking, man, I can actually walk into this paint manufacturing company. He's got all this brand new equipment. He's invested $1 million extra. I can just crank it up, right? I can just run more sales through it. I can actually send my sales team out and go get some more money. When I bought my first restaurant, I walked in the first day with new POS systems, new cameras, new everything the first day, right? So I bought the restaurant, but then I came in with a bunch of new equipment over the top. I did that because I wanted my plan to start sinking in very first minute, very first day, and they leaked out money. So my investment was back into control mechanisms for profit. All right, so return on investment, the next one. Return on investment is one that most people kind of get confused at. Its most common purpose is to say, should I have invested in this company, or should I have invested in this mutual fund, or should I have done this? It's to compare two different types of investments. Should I have done X or should I have done Y? In this case, he still got his 11,000 and he made, but he's put in 1.5 million. And that means of the 1.5 million, he's gotten less than 1% return, right? 60 years of effort, 60 years of blood, sweat, tears, family, fights, everything for less than 1%. It doesn't make sense to me, folks. I mean, for less than 1%, he could have done anything. Matter of fact, he probably, if he did just put his money into a can in the ground 50 years ago, there might be some value in the money over and above the 1.5. You might have a rare penny or rare, mercury dime or something in there, and actually be worth more just sitting in the ground for 50 years than the 1% that they actually made, right? Now, everyone else makes 16%. So you can actually do good in paint manufacturing because you'll get 16%. That's a big difference, right? less than 1% for Sammy, when all of his competitors are making 16% on their own investment. So this is really a mismanagement of assets. So I'm gonna say terrible. But let me show you something that financiers use return on investment for, right? A lot of people don't know this. If you've ever heard the term multiple, like I will give you 2 times EBITDA for your company, right? When you're buying a company, you'll hear people say, I'll give you 2x revenue, 5x revenue. Software companies like mine are trading at 10x revenue. That's telling you a couple things. That's telling you what the return on investment is that the buyer is expecting, right? So if I want, and I'll tell you, if anybody offers you 2x anything, they've really just kind of slapped you, right? They told you have a terrible company, and they told you exactly what they want to make if they bought it, right? They're saying this company is such a high risk that if it do buy it, I want a high reward. And here's what I mean by that. We got 2x, and I'll write it up here at the top. If you take the 2x, you got 100 divided by 2 equals 50% return. That's what they're looking for. They say, hey, I want to make 50% on my investment. If I buy your company, it's only worth 50%. Here's where people get really, why somebody would take a 2x. This company makes $11,000 a year. If I offer them 2 times EBITDA, that our EBITDA is 323, that means I'm going to offer them, we'll say $750,000. So, hey, I'll give you $750,000 today, whereas it would take you, I don't know, 50 years, whatever 750 divided by 11 is, to make it on $11,000 a year. So some people look at it that way and go, oh, that's a good deal. It's still a good deal for this guy buying it at 50%, right? And when we're talking about a company that wants to buy or trades at 4x, right? I want to do 4x, 100 divided by 4. They're telling you that they want a 25% return, right? That's what that means. Here's something really interesting. What's a fair value for this company, right? Fair meaning, what's the average company trading at? Well, it's at 16.4. So if I go 100 divided by my 16.4, that equals 6.1. So if I was starting negotiations here and I thought it was a fair offer, I'd say, hey, listen, I'll give you 6.1 or 6 times EBITDA. That's how you come up with a number. So when those numbers just aren't out of the blue, they relate directly back to the return on investment that the purchaser or the investor is wanting to get, right? That's where those multiples come from. Okay, good. Kind of moving on. We've got sales to assets, all right? So again, the only reason to buy assets is to generate revenue and make profit. This is going to tell you how much to forecast out. If I buy new stuff, this is saying for every dollar that I invest in a new piece of equipment, how much more sales can I expect? And I see business owners do this all the time. They go, oh, I'll probably make 10,000 more. Well, it's not a guess. This number here tells you exactly how much you can expect based on what you do today. If you don't change the way you operate, this is what you can expect to happen. So in this case, we got sales of 7,100. Sales of 7,100 over the assets that we already have, 3.6 million. That tells you that for every dollar we've invested in assets, we generate 1.98, $1.98 in sales. For every dollar that goes in, I generate $1.98 in sales. What about everyone else? They get $2.30, right? Again, there's an opportunity for improvement. I know that I don't have to buy more assets and I can make more money with just what's there. In the financial impact section, I'll tell you how to calculate the difference between these two, right? What is the actual dollar opportunity? Now, the next one is the next 6. The next 6 are really important and they are related directly to the working capital cycle. When I say cash flow is a problem, these 6 calculations are directly the levers that a manager has to use to change his fortune in cash flow. These next 6. So we got inventory, and the 6 are tied together. So there's really 3 numbers, but it goes in inventory to days. So inventory, when you buy inventory, it sits on your balance sheet as an asset. When you sell the inventory, the asset gets moved off of the balance sheet because it's no longer there and onto the income statement in the form of cost of goods sold. It becomes an expense. And so what you bought it for, if I buy something for $1, I'm going to move it off the balance sheet for $1 and convert that to an expense on the income statement for $1, right? The historical cost of the inventory actually becomes the cost of goods sold. So in this case, we went through $4.9 million in inventory, but we still have $1.2 million on the shelf, right? That's basically what this is saying. We sold $4.9 million worth of inventory, but we still have 1.2 sitting on the shelf. So our turnover rate is 4.04. So 4 times a year. Doesn't sound too bad, right? 4 times a year it turns. The thing about the next 6 is that they determine the speed of cash. Speed of cash is everything. The way to solve cash flow problems is to increase the speed of cash. This is saying we move it 4 times, right? We have to rebuy inventory 4 times a year. Everyone else has to rebuy it 5 times a year, so it's faster. I'm doing it more often, right? So the higher that number is, the more it's moving faster. In order to understand speed, we convert the turnover rates to days, right? Because we can understand days better than turnover. So when I take 4.04 and divide 365 by it, it takes me 90 days. Now it makes a lot more sense. Oh, every 90 days I buy more inventory, or it sits on the shelf for 90 days. Right. I worked with a tire dealer in Wasilla, Alaska, and I understand that you can see Russia from there. Right, is what I hear. But anytime you work with a business owner, first thing they want to do is go take you on a tour. Hey, let me show you the shop, and I love doing those type of things. Right, I like to see how people set up their business. I like to see how it runs. And this was no different than any other tire dealer you've probably been to. They got the front office, desk area, waiting area. They got these bays, and then out back they have a warehouse full of tires. And in tires, I don't get really excited about tires at all. But I did this time, right? Because I seen tires that were this wide, wider than I am, and taller than I am. Like, oh my gosh, how much do those things cost? He said, oh, they're $3,500. I sell them for $7,000. Well, that's pretty good, right? 50% margin on tire, 100%, I guess, on tires. It's pretty good. Or markup versus margin. Remember we went through that. So I'm asking him, I said, I'm counting them up. He's got 1, 2, 3, 4, 5, 6, 15, 16 of these tires. Quick math of $3,500. There's $50,000 worth of tires sitting on this shelf, right? I said, how many of those you go through a year? He said, I don't know, 2 or 3. Well, there's 16 of them there. I said, why do you have 16 on the shelf? He goes, well, I'm about the only guy that carries these things. And, if there's a run on them, I'm going to have them. I'm going to always have them in stock for our people. I said, how long does it take you to get them? He said, about 3 weeks. I go, wait a second. It takes you 3 weeks to order it in cold, but you have 16 of them here, and you only sell 2 or 3. That's, an extra $40,000 you have sitting on the shelf that could be in your pocket. Right? That turnover rate was atrocious because it always sat there. And let me tell you something about tires. If you just leave a tire to sit, it's going to go bad, right? Because the petroleum or the oil that's inside the rubber doesn't get a chance to exercise its way through. It doesn't keep the rubber pliable, and it dries out. You've seen it happen if you see a car sitting out somewhere. Tires generally are the first to dry rot, and that's exactly where these things were heading. What can you do then but donate them to a children's playground, for padding and the playground equipment? We don't want to do that, right? So let's try to look at what we're doing and make sure we're keeping cash in our pockets and not setting it outside in the playground, right? Basically what I'm telling you. So is 90 days good or bad? Well, in this case, everyone else has 66 days. That's important to know. No, because that's telling me right up front that I have too much inventory. There's too much. So 1.2 million is too much. I don't know exactly how much we should have yet. I'll tell you how to calculate that up in a second. But I already know that I have too much inventory. That's telling me right there up front. And what I want to do is convert that to $1 because a business owner will understand how much is too much. You have $50,000 too much, right? That money could be in your checking account and not in the vendor's checking account. So that's inventory days. The number we want to remember off here is 90, right? So keep that to the side, 90 in inventory days. Our inventory sits for 90 days. Okay, the next two levers, AR versus AP. AR and AP, accounts receivable versus accounts payable. And there is a relationship there. That's why I got them on the same page. Accounts receivable is how well do my customers like me, right? They like me so much that they're willing to pay me, and they pay me in a timely manner or not, right? That's how I measure it, is how much do my customers like me. This is saying how much is owed to me right now. So when I take it against my sales volume and I look at the balance sheet and determine how much is owed to me, right now I'm owed 654,000 on 7 million in sales. That tells me the turnover. How many times per year do I get paid? In this case, it's 11 times per year. Right? I get paid 11 times a year. Is that good or bad? Well, when I compare it to the industry, everyone else gets paid 8 times a year. Well, actually, I'm better than everybody, right? I'd rather get paid 11 times than 8 times. So some people read that backwards, saying, oh, no, we're already bad on everything. We're probably bad on this too. No, this company is actually good at collecting, right? When we talk about it, they get paid on average in 34 days. I don't know about you, but that's pretty good to have a whole company get paid in 34 days when everyone else has to wait 44 days. Now, these two, ARAP, are your best weapons to fight short-term cash flow problems. First of all, let's think about AR. My advice for companies when they're trying to do collections is to stay close to the industry average, because the market's already set that. That's what everybody's used to. If they don't buy from you, they can buy from another competitor and they can get it in 44 days. When you get tighter than that, your competitors or your customers will have a choice to go to one of your competitors. For instance, if you're at the industry average, they don't know any different. If you're more aggressive and so they pay you sooner, yes, you get paid sooner, but you might make them mad and ultimately hurt your sales. For instance, if I buy something and you give me an invoice, and 5 days later you shoot me an email, and 10 days after that you give me a call, and then all of a sudden you come by the house, and then all of a sudden you pick up my kids from school. I mean, who knows what you're going to do, but your aggressive collections behavior may drive me away and it hurts your sales. So I say stay at the industry average. If you have a short-term cash flow problem, you can always make a few phone calls, bring some money in a little sooner, and then loosen back up. People don't mind that. They do mind the aggressiveness all the time. But here's what I'm telling you about this company. Sammy's wife is named Attila, or at least her nickname's Attila, because she's really aggressive, right? She's really aggressive. I seen a sales guy. She chased the sales guy out the door one day when I was there, and she goes, "This one's thunder. This one's lightning. You don't want to get caught in the rain." And the guy ran out the door. So she's really good at her job, and she loves to make phone calls. That's basically what I'm telling you right here. I mean, because people like to pay her. Now, on the flip side of that is, are we paying our own, right? So we got 90 days. I want to circle 34. We're going to need that for the next calculation. This is how well do we love our vendors, right? The people that give us our inventory, the people that we buy our things from, is accounts payable. Again, it's cost to get sold because that's our inventory, right? We owe people for our inventory. And then accounts payable is how much more do we owe? So our cost to get sold again was 4.9 million over 750. That's how much we owe our vendors currently. So what's the turnover on that? That means we pay our vendors 6.5 times a year. We're making payments 6.5 times a year when everyone else pays them 11 times a year. Yeah. So what does that mean? 11 times a year. That means, think about that. If you were my customer and you only paid me 6 times a year when everybody else paid me 10 times a year, I might get mad. That's what I'm saying. You should hover close to the industry average. And this is called stretching your payables, right? That means I'm waiting longer to pay. And if we convert that to days, I'm paying in 56 days. Everyone else pays in 34 days. You stand out. You're the tallest blade of grass, and usually the tallest blade of grass gets cut. So that's where you don't want to be. You don't want to be where your vendors are saying, you're a bad customer because you don't pay me. And in this case, she's waiting almost 2 months to pay an invoice. Right. So as much as she loves to make phone calls up here, she's not answering them at all. Right. She's letting the phone ring because it goes 2 months. But if you're hovering around 34 and you get into a cash flow problem, you can stretch your payables for a short term, solve the cash flow problem, and then loosen it back up, right? Or back to average. So those are the levers that I like to use is inventory, AR, and AP because it helps me solve short-term problems. If you're too fast, I don't have anywhere to go. I can't get faster. If you're too slow, I can't get slower, right? So you want to be near the average because it gives you room to maneuver in the future, right? Gives you room to maneuver. Now, look at these two numbers. I get paid in 34, but I wait 56 days to pay. This is a red flag by the bank, red flag. And here's why it's a red flag. Because you're getting money. How come you're not paying your bills? Right? That's what they're asking. You're getting paid, you're just not paying. So when we talk about cash conversion, that's the relationship that they're looking for. Is your money even coming in? If it's not, we understand why you're not paying. There's a different cash flow problem. But if you're getting paid and not paying it, they're going to dig deeper into why you don't have enough money to pay your own bills. All right, so that's basically what I'm telling you is stick close to the industry average. Those three numbers that I circled, 90 days of inventory, 34 days of AR, and 56 days of AP, those are used in what we call the working capital cycle. It's the cash conversion cycle, right? And let me show you what that looks like vertically, or I'm sorry, horizontally. The working capital cycle is how long does it take for you if you pull $1 out of your pocket, buy some inventory, sell it, wait to get paid, and the dollar comes back. How long does that take? Right? And this is how you determine how much money you need in what's called the financial gap or the cash gap. So let me explain that and kind of draw you a little diagram here on a bar napkin. This is one length of time. I take money out of my pocket or I make an inventory order and inventory sits on the shelf for 90 days. Then all of a sudden we sell it. Somebody comes and buys it. I give them an invoice, and then the invoice sits on their desk for 34 days, right? That's one length of time from here to here, one length of time. Now, we want that to be fast, so we have to either shorten AR days or shorten inventory days. That's how you make it faster, because right now 90 and 34 is 124 days. Right? That's the way we look at that. It takes 124 days to get money back. But we don't always pay day one, right? We have what's called AP. And our AP days down below, this is money going out. So this is money coming in. This is money going out. AP days is 56, right? That's how long an invoice sits on our desk at Spectrum Manufacturing. In order to make this gap different, right? We're going to look at this length of time versus this length of time, right? That's called the financial gap. The difference between the top line, the in, and the out, the financial gap. The financial gap is used to figure out how much working capital you should have. A lot of people don't know how much they should have, and it's different for every company, and it's based on these three numbers. This is how much working capital it's necessary to run your business, right? And it could be cash, it could be a combination of cash and line of credit. Somehow you have to have access to this, right? Financial gap. In this case, we've got 90 days of inventory and 34 days of AR minus the AP. 56 gives us financial gap. If we were in London, I'd say, hey, mind the gap, right? That's basically what I'd say is mind the gap. But we want that to be small. So in order to be small, we have to move the top line in or move this one out. And that means it's a smaller gap. In this case, here's how you calculate it. You got inventory plus AR minus AP. That equals gap days. You need money to run the business on the gap days. So you got 90 plus 34 minus 56. In this case, it's 68. 68 days. I need 68 days worth of cash. How much cash? Well, that's based on either sales or cost of goods sold. The cost of goods sold number is more conservative than the sales number in our case. So let me kind of look forward and calculate that. If you look at it, these are just two circles running in conjunction. Sales kind of drives it, but it's cash, inventory, accounts receivable, how it comes back. But let's talk about how much it takes to borrow, right? The financial gap determines how much you need on your line of credit if you don't have any cash. The financial gap gets converted to borrowing need. This is the same calculation I teach at banks all around the country on how to determine how much somebody needs on their line of credit. So in our case, we have 90 days of inventory, right? And I'm just going to say, what if we increase sales next year by $1 million? All we're going to determine is how much more money we need. You can do this for your current company. You can do it for future value. It doesn't matter. But in this case, I'm saying if sales increased by 1 million, how much more money do I need to run this company? So inventory days is 90 plus our AR 34 equals 124. 124 minus 856 equals our financial gap of 68 days. We'd already went through that. Now we're saying that what if we increase by 1.1 million? If I take 1.1 million and I divide it by 365 days, I'm taking my average new sales divided by per day. So I'm breaking it down. It's this many sales dollars per day. That's $3,000 per day new. That will be coming in on $1 million. I take my $3,000, multiply it by my financial gap days, and that says I need a line of credit of 205,000. Boom. It sounds a whole lot better than if I walk into the bank and I say, hey, banker, I need a loan. And they say, how much you need? And I go, I don't know how much you give me. Right there, you're starting off bad with the bank. But if I walk in and I say, hey, listen, right now, my working capital cycle, I got about 90 days of inventory. I'm getting paid in 34 days. I pay my bills in about 56 days. Based on that, I'm going to need $205,000. Sounds a whole lot different. You're starting to understand, or let the banker understand, that you know the dynamics of your business and you understand how your business operates and how to get money in and out of it. Okay, but if we went back to Sammy's situation, Sammy wasn't going to increase sales by 1 million. He says, I'm going to get the true value contract, and the true value contract was worth 3 million, right? And he said he needed 300,000. We don't know if he needs 300,000 or 200,000, right? We need to figure out how much he really needs to finance that line of credit or the inventory for the new contract. So what if we want to grow by 3 million? He gets the $3 million contract from True Value. We still got the same way he runs the business. 90 days of inventory, 34 days of AR, minus 56 days of AP, still 68 days. But this case, I got $3 million in sales. Sammy, I want like anything for you to get this contract. If you get the contract and you add $3 million in sales to your company, that's going to be an average of $8,000 per day. You have a gap of 68 days of cash that you have to fill. So if I take your $8,000 times your gap days, you need a line of credit of 559,000. Boom. Right? He asked for 300,000 because he just swagged it. He goes, about 10%. No, he needs 559. If we give him the loan as the bank, if I give this guy a loan, I've sunk his ship because I put him in a position where he can't win. He won't have enough money to actually fill the orders, right? He won't be able to buy the inventory. He's only got $300,000. He needs 550,000 to make it done. That doesn't mean we stop. Remember, I got 3 levers. I got inventory, AR, AP. Those are 3 things I can manipulate. Maybe I'm not ready today, but maybe I use one of my levers and change the situation, right? I change the situation. I don't think he can stretch AP out any farther. I think it'd be really hard to collect faster. So really we got inventory. And if you remember, the industry average is 66 days. So we can at least reduce inventory down. If we do that, he's actually going to have more cash, right? Because if we do it through attrition, as he sells it, just don't replace it. Keep the cash in the company, don't replace it. And when you do that, you're actually going to put your company in a better health position and keep cash in the company, right? Rather than replacing it, spend it more back with the vendor, you actually keep it in the company. So let's reduce inventory to 60 days, just for easy math. So I got inventory at 60 days, AR 34 still, gives me 94. 94 minus the 56, because I'm still paying it, gives me 38 gap days. Using the same figures, I get the True Value contract. All I did was reduce my current inventory. I got times 38 days. I need 312,000. Boom. We can put him in a position to where he can actually only need 300,000. Thing is, he doesn't know what he needs. This is how you figure it out. you need a line of credit of $312,000 to be able to finance your true value contract. So next week, when we start, and we're going to end just a few minutes early because I don't want to start a new thing today, but next week, we're going to go over the financial impact, right? This is where you say, okay, because I'm not as good as my competitors, because I'm not average, this is what it's costing me. This is the hidden cash calculator, right? So I'll write that on there. It's the hidden cash calculator. Before I tell people they need to increase sales, I make sure all of these 6 things are right. If they're not right, we fix them first before we increase sales. Because here's where money is just sitting in your company you're missing out on. This is like taking a metal detector to your company financials and going, oh, there it is. I see exactly where I can get money. And when we look at this next week, you're going to be able to see exactly where to go get money in any company that you work with. Right now, we can analyze the company, use the industry average to compare it. Next week, we're going to take our analysis and convert it to cash. What's the financial impact of not being good? So, Chris, I know we're about 5 minutes early. If somebody's got some questions on what we went over, you should be walking away from this knowing exactly how to calculate a line of credit. That's my hope. And, Chris, I'm going to turn it back to you, buddy.
All right. Thanks, Mike. Appreciate it. Thank you, everyone, for joining us today. I will send up a follow-up email, as always, with the recording as soon as it becomes available, and it will also have all the info for next week's session. So if you have any questions, please feel free to reach out to me or Mike. He'll be copied on that email as well. And again, thank you, and thank you, Mike, and we will see you next week.
See you next week, everybody. I'll be in Atlanta.
Woo!
There you go. All right. Take care. Thanks, Chris.